Hey, what is going on, everybody? Welcome to another video in which we are going to see one of the most important things that you are supposed to know, and that is how to save income taxes. So today in this video we are going to see 5 important tips that you are supposed to know in order to save or reduce your income taxes. So before getting started, I would like to introduce to you our free Android app, that is FinCalC, which is a financial calculator app exclusively for the people of India that will help you to calculate your income taxes and track on monthly basis. Also, it allows you to calculate the interest on savings accounts, fixed deposits, recurring deposits, PPF accounts, and many other Indian saving schemes. So don't forget to download our free Android app, which is FinCalC Financial Calculator, exclusively for the people of India. You can see the link on the top right corner of this video right now. Also, you can see the link to download this app in the description section. So let's get started with these 5 important tips in order to save or reduce your income taxes. So the very first tip is using your provident fund. So Provident Fund is a type of fund that is available to you if you are working as an employee in one of the organizations and you have opted for Provident Fund. So a small fraction of your salary is taken every month and invested in this Provident Fund. So the investments made under Provident Fund in the entire financial year are taken into consideration and is subjected to the deduction under Section 80C. So these investments that you have made under Provident Fund in a particular financial year can be used in order to reduce your taxable income, which will help you eventually to reduce your income taxes. The second tip is using your public Provident Fund. So a public provident fund or PPF is an Indian backed government scheme that is available to you and you can make investments every year. The investments made under public provident fund are also subjected to a deduction under Section 80C. Either you can choose to invest one time in a particular financial year or in the form of installments for a maximum of 12 installments in a financial year. The third tip is making investments in ELSS, that is equity linked savings schemes. So equity linked savings schemes or ELSS is a type of mutual fund that invests your money in equity. The investments made in ELSS are also subjected to deduction under Section 80C. But the important thing to note over here is ELSS is for a minimum period of 3 years. So if you are ready to invest for a minimum period of 3 years, you should definitely go for ELSS, that is equity linked savings schemes, and claim deduction under Section 80C. The fourth tip is using your life insurance policies. So whether it is a term insurance or a money back policy, the premiums that you pay every financial year can be used to claim deduction under Section 80C. One very important thing to remember over here is the maximum amount of deductions that you can claim under Section 80C is rupees 1,50,000 in a particular financial year. That means the investments that you have made in the top 4 tips, that is provident funds, public provident funds, ELSS and life insurance policies, the sum of all the investments should be less than or equal to 1,50,000. Maximum of rupees 1,50,000 will be taken into consideration for the deduction for that particular financial year. The fifth tip is using NPS, that is National Pension Scheme. If you have an NPS account, you can make a maximum investment of 50,000 in a particular financial year and claim the deduction under Section 8 CCD. Now this limit of 50,000 is apart from the 1,50,000. Remember, these two sections are two different sections, that is ATC and ATCD. In ATC, we have a maximum limit of 1,50,000, whereas in ATCD, we have a maximum limit of 50,000. So a maximum of investments that you can make under these two deduction sections are 1,50,000 plus 50,000, that comes to around 2 lakh. Remember, your aim in this particular financial year, that is 2017 and 18, should be to get the gross taxable income to rupees 3 lakh or less. So for a taxable income which is less than 3 lakhs, there will be no income tax that will be applicable for that particular taxable income. So for more information on how you can calculate your income tax for the financial year 2017 and 18, you can watch our video, the link to which is on the top right corner of this video right now. It also contains different examples as to how the income tax will be calculated for the financial year 2017 and 18. So that's it in this particular video. Hopefully you have understood what are different 5 important tips that you can follow in order to reduce the taxable salary, and also eventually which will reduce your income taxes to be paid in a particular financial year. So don't forget to subscribe to this channel, like and share this video. Also don't forget to download our free Android app FinCalC, which is a financial calculator exclusively for the people of India. The link is in the description section. Stay tuned.